CoinDesk managing editor of technology, Christie Harkin, in Toronto, on the other side of Lake Ontario. Good morning, good afternoon rather, and managing editor of markets, Brad Keoun, in Austin, Texas. Welcome, both of you.
Thanks, Lawrence. Thanks for the compliment. I like the contrast between your description of us and the description of the chart.
Hey, it's a Friday afternoon. People want something bright to go into the weekend, especially it lasts a couple of weekends of August. But yeah, Brad, you brought this chart to everyone's attention here. So what's your take on the price action shown in the chart? And also, it seems that the big issue here in the markets right now is this fear that about inflation and what's going to be done with it. That still persists, correct?
Oh, for sure. The big picture, kind of stepping back, if you look at that chart, we had this rally, obviously we had this huge crash you can see over on the left of that chart in May and June, and it took us down into the teens, and that was kind of the beginning of the crypto winter, right? And then we were sort of in crypto winter for a while, and then kind of in July and beginning of August, we saw this comeback, and we made it all the way up to 25,000. And what we're seeing here is the market could not hold that. And, I think to your point, Lawrence, Bitcoin, there was some maybe speculation that there might be some decoupling between Bitcoin and macro. And what we're seeing today is, very much still tied at the hip. Bitcoin's still trading more like a risky asset, than an inflation hedge. We're seeing more signs of inflation around the world, and it's increasing speculation that the central banks are just going to have to keep their foot on the brake. And so you're seeing a big sell-off today.
Yeah, all those people on Twitter who promised me that Bitcoin was going to be an inflation hedge over the years. It's not quite showing that, is that? Christie, meanwhile, seems like the only way miners make money is by not mining.
Well, it seems to have helped to a certain extent when it, at least for Riot blockchain. They managed to get a whole bunch of money in credits for not mining, for turning off their equipment in Texas, which sounds a little counterintuitive, but according to this, we were sort of doing some back of the napkin, and by we I mean other people on our editorial team were doing some back of the napkin calculations, and it seems that they got something like 9.5 million in power credits, which we know about, but that equates approximately to something like 439 Bitcoins computed using the July 22 average BTC price of $21,634. So they would have had to mine 439 Bitcoins to make that much. And that's actually quite a lot of Bitcoin for them to have mined. So they probably made more money in the power credits than they would have if they'd kept mining.
Hear that, miners? Just go to Texas and do nothing. We are, I think, contractually obliged to mention Tornado Cash this week, all of us, and what's going on right now with Tornado Cash and what has happened this past week and its repercussions. Who wants to take a bite at that one first?
Oh, I'm all over that one. Yeah. Okay, it's not Bitcoin. Let's just start off by saying that Tornado Cash is not Bitcoin. Tornado Cash primarily deals with Ethereum-based, or maybe exclusively works with Ethereum-based tokens. So this is not a Bitcoin thing. However, it would be very, very foolish for Bitcoiners to not be paying attention to it and to think that we're all in the clear, because heck no, we're not. This was a decentralized mixing platform, and mixers are generally used to obfuscate the path of your coins, the transactions prior to what you've been doing, for the purpose of privacy, maintaining privacy. And they do that by mixing your coins with a bunch of other coins and other transactions, and it all spills out on the other end, and it's all harder to read. Now, the thing is, And again, it's a decentralized platform, and it was the code itself that was sanctioned, and the guy who wrote the code, not necessarily the people who used the code, which is really bizarre and backwards, and its own privacy concern right there. But one of the things to keep in mind with Bitcoin is, yes, Bitcoin has quite a few decentralized mixers, including Join Market, which is a pretty awesome mixer from my understanding of it. And we are in Bitcoin actually already taking measures or taking steps on the development side to counter some of the issues that will be popping up in terms of tracing coins that run through mixers. One of the issues is that it's actually pretty easy to look at a transaction and figure out whether or not that has been touched by a mixing service. And ever since we implemented Taproot on Bitcoin back in November, I believe it was, that changed the signatures. And I don't want to get too technical, but it basically, Schnorr signatures allow different transactions, whether they're multi-sig, which is what you're looking at with a mixing transaction, is a multi-signature because it's a lot of people involved in it, a lot of people mixing their coins. You can actually obfuscate whether or not that has been using a multi-sig transaction or not. And it makes multi-sig look like a vanilla you to me kind of transaction, peer-to-peer transaction. So there are things that are being developed. It's not in place right now. We do have Schnorr signatures, but everything in Bitcoin, as I always say, moves very slowly. And they're still working on making the reality of privacy, of the privacy promise from Taproot on Bitcoin a reality, like making that a reality. So we've got quite a few things in the works that I think people can probably have some confidence in down the road.